Hi everyone. In the first video lecture for Chapter 3, we talked about the rules of debits and credits. That video ended with a discussion of the expanded accounting equation and the normal or expected balance associated with each of the 6 categories in the expanded accounting equation. Assets have a normal debit balance. All asset accounts, including cash, accounts receivable, inventory, prepaid expenses, buildings, all have a normal debit balance. Liabilities have been assigned a credit balance. Accounts payable, notes payable, income taxes payable, unearned income are all examples of liability accounts, and all of them have a normal credit balance. Owner's equity, which in a sole proprietorship is the owner's capital account, has a credit balance. All income and revenue accounts have a credit balance. So fees income, commission income, consulting revenue, sales, for instance, all have normal credit balances. Expenses have all been assigned a debit balance. So rent expense, wages expense, insurance expense, for example, all have normal debit balances. And the owner's drawing account has a normal debit balance. When I went to school a long time ago, I was asked to memorize the expanded accounting equation, which, by the way, I am asking you to do. Please memorize this expanded accounting equation. I was also instructed to memorize the normal balance for each account category. However, since then, I have found a mnemonic which will help you memorize the accounts that have normal debit balances and the accounts that have normal credit balances. By the way, as shown on this page, debit has the accepted abbreviation of DR, and credit has an accepted abbreviation of CR. So let's look at dead coil. Dead, D-E-A-D, coil, C-O-I-L. D stands for debits. And each of these account categories have a normal debit balance. E, expenses, A, assets, D, draws. If you want to increase the balance in any expense, asset, or the owner's drawing account, you need to debit these accounts. They all have normal debit balances, like signs add, so debit these accounts to increase their balance. If you want to decrease the account balance, on the other hand, in any expense, asset, or drawing account, you need to credit the account. These accounts all have normal debit balances, so to decrease the account, you need to credit the account because opposite signs subtract. For example, if you want to increase the cash account, you need to debit the account because cash is an asset with a normal debit balance, and like signs add. If you want to decrease the balance in the cash account, you need to credit the account because cash is an asset with a normal debit balance and opposite signs subtract. The balance in cash will be increased with a debit and decreased with a credit. C stands for credits, and each of these account categories have a normal credit balance: owner's equity, income or revenue, and liabilities. If you want to increase the balance in the owner's capital account or in any income, revenue, or liability account, you need to credit the account These accounts all have normal credit balances, like signs add, so credit these accounts to increase their balance. If you want, on the other hand, to decrease the balance in the owner's equity account, income, revenue, or liability accounts, you should debit the accounts. Again, these accounts all have normal credit balances, opposite signs subtract, so debit these accounts to decrease their balance. For example, fees income is an income or revenue account with a normal credit balance. If you want to increase the balance in fees income, you must credit the account. Accounts payable is a liability account with a normal credit balance. If you want to increase accounts payable, you must credit the account, like signs add. On the other hand, if you want to decrease the balance in accounts payable, you must debit the account because opposite signs subtract. Well, that's all for this video. You might want to print out Dead Coil. It's a handy spreadsheet to keep with you when you're working through your assignments for Chapter 3 and for future chapters. See you next time.